Welcome to today's Finextra Research webinar, Predict 2026, New Financial Fabric, Digital Assets, Smart Infrastructure, and Global Resilience. I'm Scott Hamilton, contributing editor for Finextra, and I'm here to lead a conversation and explore important insights on that topic with our audience. But before we jump into what should be a fantastic discussion with our roundtable of experts, two quick notes. You're encouraged to ask questions. We'll do all we can to answer as many as we can during the session. And you'll have a chance to weigh in on two audience polls as well. Now, digital assets aren't new. They've been around for quite a few years, and we'll hear more about that history today from our panelists. But boy, are they the talk of the town right now. And the stablecoin train in particular doesn't show any signs of slowing down anytime soon. And that's why we picked this topic for our first of several Finextra Predict 2026 conversations this year. Now, with so much already said, written, pontificated, extolled, threatened, and anguished about this subject, including right here at Finextra, we thought it was the perfect time, right at the beginning of a new year, to get this group of experts together and talk tokenization and what's next. These are the people who know digital assets, who live and breathe their possibilities and their potential concerns every day, who are actively building new frameworks and teams to support and promote them as part of more efficient and inclusive financial ecosystems to meet the current and longer-term needs and appetites of their institutions and, of course, their customers. Now, tokenized money and blockchain innovations aren't just arrived, but they're here to stay. So the questions everyone's asking are, where will all the pieces fit into their overall deposit, investment, and payment plans, both now and in the longer term? And what choices and decisions must banking and fintech companies organizations make right now or soon to make the most of this opportunity and stay competitive or not? It's not just about lower costs, speed of execution, or other efficiencies, though those factors loom very large in any discussions around tokenized deposits, stablecoins, and decentralized finance in general. In fact, things blew up in the DeFi space last summer amid a plethora of US imposed tariffs, and it no longer took a genius to figure out that stablecoins, for the US government's first major shot into the global digital asset regulatory marketplace, we're going to be a very big deal on the worldwide stage, and probably faster than anybody but their most ardent promoters ever thought. But in the wake of the Genius Act's arrival, and with much more on the global developmental and regulatory agenda, like the EU's MiCA, the Markets and Crypto Assets Regulation, happening now or coming soon, issues have arisen around financial stability, monetary sovereignty, security and governance of these new programs and products, and of course, how it's all really going to work together, especially if multiple regions or countries start issuing their own stablecoins, for example. Indeed, interoperability seems to be one of the most crucial factors involved with the global and even local exchange of digital assets. And practicality and consistency, on the other hand, are the first demands of most banking clients for efficient and effective financial management and payments, and especially cross-border commerce. You can't have these if the answers include a whole bunch of different independent and disconnected private exchanges masquerading as workable solutions for a financial community. It's one that demands not just 24/7 liquidity, but low friction on-ramps and off-ramps for stablecoins and other tokenized assets. Nobody wants to jump on board this train, no matter how compelling or enticing its potential benefits might be, just to have to do it again and again because of regulations or monetary policy constraints imposed in each new country or region or in another few years. And then, of course, there's AI, and we'll be touching on that new technology's impacts on all of this as well. So it's a lot to tackle, but we've got an exceptionally experienced and talented group of panelists to do it today. Mike Foy, Chief Financial Officer of Amina Bank; Atakan Bakiskan, U.S. economist for Berenberg; Duraj Bajaj, Global Head, Financial Institution Sales, Transaction Banking for Standard Chartered; and Fabrizio Berlando, Chief Executive Officer for Bancomat. Mike, your bank is a pioneer in the digital assets field there in Switzerland. Let's kick off the session with your especially long view of the current digital assets landscape and how we got here, and what you see coming this year in 2026. How can financial sovereignty be retained while enabling that global interoperability in financial services we're talking about?
Brilliant. Well, first of all, Scott, thank you very much for having me today. It's a pleasure to be here. Really, really good questions to kick off the session. And I actually think your train analogy is a really good analogy, but I'll touch on that a little bit later. So yeah, I work at one of two crypto banks in Switzerland, and when I say crypto bank, a bank that was founded on the premise of a significant role that digital assets will play within the global economy in the future. Switzerland was at the forefront of that technology, obviously being one of the founding places where Ethereum was founded, and a lot of the crypto valley in Switzerland is pioneering in the digital asset space in particular. Um, Current digital asset landscape, that is a really interesting question. And I don't think anybody can convincingly say to me that they know the answer to this categorically. And what we've seen is that the trends that we thought were going to be really big have disappeared just as quickly as they arrived. And trends that we didn't see really coming have really thrived almost unexpectedly. I think for me, what is certain is that a lot of the trends we saw in 2025 will probably continue. And for me, chief among those is institutional adoption. We are seeing a significant trend ever since the ETFs were launched.
Hold while we connect you to your webcast.
Sorry, I think Diraj might be connecting, but we're almost there. Let's pause just a moment, Mike. Sorry. Let's go ahead and are we ready to keep going? I think, Mike. Let's proceed.
Sure. Absolutely. So institutional adoption, this was a key trend that we saw throughout last year. We're seeing more and more large institutions coming to the forefront, publicly announcing how they plan to tackle the challenge of digital assets. We're seeing demand and increasing levels of sophistication from crypto OGs across the industry. This trend is clearly going to continue. The cat is out of the hat, and this is not going to go away anytime soon. And we're going to see this trend continue. I think you touched on it really, really well with your train analogy with stablecoins. Stablecoins, anything to do with stablecoins is a super hot topic. Everybody saw how successful the Circle IPO was last year, and I think that defied my expectations for sure. And I think we will see more and more innovation in the stablecoin space. I think the macro environment in a lot of countries where interest rates tend to be reducing quite significantly, I think that is going to impact the yield that a lot of these stable companies have lived off for quite a few years. And that is actually having a really beneficial impact for the industry and for the users of stablecoins, because it's forcing innovation. It's making these stablecoin companies look at how they transact payment-wise, look at how they integrate, the rise of payment networks, the rise of reward tokens, and looking at how they can create yield or reward potentially in certain cases. And then this is all compounded by the regulatory environment we have. So you touched on it in your opening. We've seen the MiCA regulation come into force in effect. Amina has recently, in the back end of last year, acquired its MiCA license. That was no easy undertaking. It took over a year and a half of solid hard work to get that licensing in place. It's really difficult piece of legislation. It's still evolving. It's still changing. We're having conversations with legal teams, and they're not really sure how to interpret all of the elements of it and all of the intricacies. Then the US, in true US style, has thrown regulation out at a rate of knots. I was blown away at how quickly some of the stuff came out in the US. I mean, I still think it's evolving, and obviously the legal system in the US is very different to the European code-based system. So for me, I'm fascinated how that will evolve in the coming months as more and more people get on board. But what I like about the US Genius Act and some of the other regulation that we've seen is it's clear. It's very US. It's like, this is what we're after. This is what we want from our sort of stable coins. And I think that gives a very, very clear message for a lot of the companies. I think for me, some of the other regulation still needs to change. It needs to evolve. And in many cases, the US regulation is a lot more commercial in my mind than some of the European regulation that we've seen. And I think we need to see more convergence and more harmonization in that space. I think one final trend that we see is that you're seeing less and less activity around IPOs and about coins necessarily just being a value proposition. People are really looking at what is the underlying technology, what's underpinning it, what are the use cases, how can that be leveraged? I think with inflection points in AI, quantum computing, these are really making developers think. And while we had a little bit of a meme coin era last year, particularly around President Trump and some of his associates, I think more and more people are tired of this. You're seeing less and less of these ICOs, and you're seeing now really the coins that have credibility. These are the coins that are long lasting. Those are the ones that are enduring. You're seeing some great work from Solana, Ethereum. Again, you're seeing people where the underlying technology is what really, really counts. And as a consequence of that, where coins haven't got that technology and maybe are living off an ICO from the early days, they're starting to struggle. And this can only be a good thing if it drives more innovation, if it drives more creativity, if people embrace the other technologies in the AI space, for example, and bring that in, then I think we're in a really, really strong position. The second question was, how can financial sovereignty be retained with global interoperability? And I think this is where your train point comes in. In the early days of the train system in the United Kingdom and the US, lots of different rail companies building lots of different railway lines. They all had different gauges. They worked on different tracks, different carriage types, different clasps to connect the carriages, different kinds of engines, different sources of fuel. And this was a nightmare. And it took a long, long time to kind of harmonize that. And I think we are only at the start of that journey. At the moment, we live in a world of two very dominant stable coins. But for me, what is exciting is the level below those top two, where we're seeing more and more innovation, and we're seeing people and projects challenging the stable coin norm, if you will. So people that are looking at this and going, actually, this should be a mechanism for payment. I think that if you look at the global financial system, look at SWIFT, look at some of the payment networks that exist for fiat at the moment, that's not gonna go away overnight. But what you are seeing is where these payment systems have been slow to change, been slow to embrace technology. I think stablecoins are going to steal their lunch, and the adoption of stablecoins is going to go even faster in these regions than maybe in some of the regions where it's more established. And that's why I think you're seeing more stablecoin adoption in Latin America, in South America, in the US, in the APAC region, sort of countries where this technology has a real purpose. And this is why you're seeing, for me, a little bit slower adoption in maybe Central Europe, where payment systems are more established. I don't think there is a sovereignty problem per se, because I think most countries have a system in place where at some point there has to be a transaction to turn this into fiat. And most of the institutions, even the exchanges that are doing this, they typically tend to be licensed. And the fiat transaction, you still have a traditional bank element in place. But I think what we will see is a convergence of those regulations, convergence of what good looks like, and how banks and how financial institutions are starting to approach the subject, starting to understand it. And actually, if we look at the fundamentals of blockchain technology and the transparency that the blockchain can actually provide, we're actually only moving into a better space, because we have much more transparency, much more visibility of what transactions have occurred. And I think in the long term, I'm talking 5 years plus at least here, you're going to start to see that some of the problems we see, they start to vanish, because we have this increased transparency, and because regulations are starting to harmonize, and we have sort of a centralized view of what good looks like and what consistent. And To use your train analogy, we're all on the same tracks, running the same kinds of engines with the same gauge.
It's early in the journey, and yet it's late in the journey if you consider the whole long tail, but it's very early in the next phase. And thanks a lot for that on the ground perspective. Let's move on real quick. We're going to get back to a lot of these things as we go along. But Atakan, thoughts you might add to Mike's comments? You're focused on economics. Talk about some of the more macro or global level ramifications of these, the various factors that play into what we're seeing with digital currencies these days in various countries, from the US with the Genius Act, countries where digital currency alternatives are, maybe serving to enhance local liquidity. They're making it more easier just to do business. Share some of your key concerns about the intentions and impacts of stablecoins, how they might be used by those local regimes as we move forward. Atakan?
Right. Thank you, Scott. Like Mike said, stablecoins have grown quite a bit in size. I think last year, November, they surpassed 300 billion market cap. And because a lot of these issuers hold treasury bills or, just treasuries, I think Tether alone just holds 2% of the outstanding T-bills. So because of that size, it's kind of hard to ignore stablecoins anymore. Again, and then, as a result, in July last year, US passed the Genius Act, a much-needed regulation that restricts stablecoin issuers to back their coins with relatively safe and liquid assets, such as T-bills, deposits, repo, or just cash, really. So that really prevents any potential meltdown in case of a coin run, I would say. But I guess the big thing from the Genius Act was that it restricts these stablecoin issuers to pay interest. And this could still keep the demand up from non-US regions. But if you can just hold your money in a bank deposit where you can earn interest, just holding a stablecoin doesn't really give you an extra value. So that would probably reduce some of the domestic demand in the US. But again, the regions outside of the US, people hold it not because of the interest, but because, to have access to some safe, sound financial system for liquidity purposes or whatever. So I guess in aggregate, it could still go up, but I don't really see the domestic demand in the US really going higher due to that interest, the interest payment restriction.
Yeah, no, I thank you very much for that. It's going to be great because we have some really interesting perspectives here today from various parts of the marketplace, large banks, smaller banks. In fact, Bajaj, first, your reactions. I think you're back now. Your reactions to your co-panelist comments. Your bank's been working with stablecoins and other tokenized assets, digital assets with clients in financial institutions and fintechs for years now. From your standpoint, every single day you're talking to your clients. Why is interoperability so important? And what do you see as the present state and maybe the immediate future state of stablecoins in the marketplace? Are they prevalent, really gaining ground, or still just niche players? And just kind of give us a perspective of 6 years or 6 months or a year from now, what it's going to look like.
Sure, thanks, Scott. I'm audible, right? Because I'm using my phone line. I hope I'm audible to you.
Got it. Yep.
Yeah, okay. So I can completely relate to what we just heard from Mike as well as from Atakan. Yes, there is, the whole portfolio of stablecoins has grown in size and shape. I can relate to the numbers that were just spoken out about it crossing 300 billion. Now, if you go back a year and a half, these numbers were closer to 100 billion. And you can see that there's been rapid increase. A few months back when we were speaking at a similar panel, it was close to 260, 270 billion. So you can see that it is increasing month on month. Are we seeing stablecoins as a mean for domestic payments? Answer is no. When we talk to other financial institutions and fintechs, there are multiple ways in which domestic payments can be done. But is there use case for cross-border payments? Answer is yes. Is there a use case for currency controlled countries where people want to save against inflation or they want to save against depreciation of their own home currency? Answer is yes. So initially, stablecoins came into play because they were largely used as settlements against digital assets or NFTs. That was the first use case. Right now, the larger use cases are cross-border in nature, as well as they are being used as a store of value, which is a kind of it's like a hedge against your own depreciating currency, as was mentioned by Atikan in markets like Africa as well as Latin America. So that's leading to a big rise. Our own, from a Standard Chartered standpoint, we've been vocal about how these are growing, and also the fact that we expect this to grow 3x and 4x in the next 2 to 3 years as more adoptions and more use cases come in. In terms of present state, as I said, it's largely used as a store of value in what we're seeing, as well as for some kind of payments, and new use cases are coming. In terms of future, we do see stablecoins filling in the space where the fiat rails cannot service. So, for example, fiat rails are today maybe 22 hours by 5 days. They're not 24/7. So if you need something to be done on weekends, you will have to go to a stablecoin infrastructure, which is 24/7. And lastly, to answer your question on where do we see this 6 months to a year from now, I do see a lot more industries coming in and a lot more use cases coming in, where beyond just a store of value, we would see these also as a medium of exchange, where specifically when it comes to 24/7, because they actually do not have a cutoff time.
Awesome. Thank you for that quick look at the landscape. And it's very, very interesting to hear now the perspective of Fabrizio Berlando. Your thoughts on this, and a question for you. Is the Genius Act from the US just the first of many stablecoin programs, for example, the efforts that we've seen with Bankomat there in your payment network and European banks to launch an EU stablecoin? And what will a stablecoin bring to the market for the EU? How will interoperability actually be accomplished across all these data variations, the transaction standards, the regulatory differences?
Thank you for having me, Scott, and hi, everybody. So I'll be a bit of a contrarian here, and I'll start by saying that I believe so far stablecoins haven't really lived up to their potential. They're mostly being used for a couple of things: for trading, for a number of traders, a small number of people and population, and for mostly developing countries. Yes, a little bit of FX, cross-border developing countries, stabilities where currencies are not very stable. But I think there's a huge potential. And the stablecoins are not really a product; they are infrastructure. And the reason why they haven't really lived yet their potential is that they haven't been adopted yet by mainstream finance and financial institutions. So we're keen to do so. For those who don't know us, Bankomat is one of the largest payment schemes in Europe. We have 30 million customers. Through an alliance in Europe, we connect 200 million consumers. And I believe there is a European way to stablecoin, which could be very strong, because when we observe what we have today in the current configuration of US dollar stablecoins, which are 98% of all the coins, so basically they are the stablecoins. There are three weaknesses which have been the strength that helped scale fast, but I believe they are weaknesses. Well, the first one, we said it, there's a dependency on only one currency, and therefore on big, let's say, FX impact. In Euro, for example, 20% of the GDP. If I want to do something, I cannot use euro denominator, and this obviously is not sustainable. But the two main issues that we see and observe, first one is that current configuration and stablecoins are controlled by a very small number of large, private and non-regulated, let's say non-financial institutions. Most of them are single issue instruments. That brings a huge risk. Operational, legal, governance, all the risk, and especially it all sits on one or two balance sheets. And that creates really single points of failures. And that's the one that we believe could and must be tackled. The second thing is the current stablecoins are missing scheme level rules and protections. We've been running a payment scheme for 40 years, and we know that the consumer protection standards, participation rules are key to a interoperable environment. And today they are absent in the stablecoin. So what we're trying to do, what we ask ourselves is that what if we took the strength that today we have in the payment scheme systems and use them to make them on-chain, programmable, all the things that stablecoins can bring us. And especially issued by regulated institutions that have transparent balance sheets. So we came up with an idea of multi-issuance based on a common standard of smart contract. So we're a scheme, we're not issuers, we don't want to be. We want to provide services to financial institutions as we're doing today with the regular money. So we believe that multi-issuance coordinated by the scheme could be the way in Europe. If you look at the 3 experiments in Europe, you either have single bank like Societe Generale, it's fine, but it's not interoperable, it's mostly used as a tokenized deposit inside the bank, not scalable. You have private coins like Circle that are not distributed by banks, and therefore, given the distribution in Europe is mostly through banks, they only cut a certain small number of population. They're not scaling because banks will not distribute them because they will see reserves flowing away from the balance sheets. And then we have consortium like Kivalis that today is trying, and I think is probably the best idea there, but still is a consortium where you need to invest, strong barriers to entry. You cannot just issue the stablecoin, the consortium issue the stablecoin. But we believe the multi-issuance based on a commons reference is the way forward and gives the right incentives to financial institutions then to jump in and to be the ones issuing based on a common standard. I'll stop maybe later on, I'll tell you how we envisage that, but I think that's the European way.
Excellent insights. And perhaps this is a great, and thank you, Fabrizio. This is probably a good time to have our first poll. Let's go ahead and put that up on screen for our audience. Really simple question, just to kind of gauge where you're coming from. What do they represent to your company right now in early 2026? Is it a core or evolving product or program you've already got in place and in operation, an opportunity you're thinking about, you're actively pursuing? Is it an interesting idea? We'll talk about it later. Or is it not a top priority at all for you right now? Maybe next year. And as we proceed, as you answer that, we'll come back to those in a minute here, see how people answer in the audience. We do have some questions. We have questions about how CBDCs fit in here, central bank digital currencies. We have questions about how stablecoins will be treated by regulatory regimes where maybe there are prohibitions or concerns on the local level. We talked about how this will make more liquidity available in certain countries, and some of those countries don't like the fact that something might replace that of their own currency. But Mike, if you give us some brief thoughts on where you see the breakthrough opportunities. You gave us a good overview earlier of kind of the whole landscape. Give us some quick breakthrough opportunities. And I know your co-panelists also have some good use cases, so save some time for those because we'll all be talking about it. Thanks, Mike.
Well, I think Fabrizio made some really good points. I agree with certainly some of them, not maybe all of them, but I think for sure he's right. I don't think the solution that will be the end solution is there today. It's getting there. We're moving in that direction, but I agree with him. I think some of the prominent players at the moment, that they're not the long-term solution, or there are too many limitations when it comes to adoption. So I definitely agree with that. I think coming back to your point around central bank stablecoins, I don't see where the innovation is coming from. I see these projects as, white elephant projects. In a lot of cases, a lot of money may be behind the project, but they're slow, they're clunky, and often by the time they come to market, that they're a little bit out of date, or they age pretty terribly. For me, it's going to be a combination of a consistent framework, and this is why I think the network effect that we're seeing with a lot of stablecoins is pretty important. I think the winner of the race becomes the network with the biggest adoption and the biggest buy-in from that point of view. And I think, to Fabrizio's point, and where I totally agree, it's about that interoperability. It's about ease of use and making it as easy and as accessible as possible for as much adoption as possible, as quickly. I think what's interesting is the idea around getting the banks to be consistent. And I think that is going to be quite difficult with the risk departments. I know, for example, we're a crypto bank. We're relatively open to digital assets, but even sometimes we face challenge from our risk teams, from our compliance teams. And I think when you go to some of the much larger banks, this is definitely a big bone of contention and a big point of discussion in boardrooms up and down. So for me, I think definitely, to Fabrizio's point, some of the banks will come in on this, but a universal banking stablecoin, and maybe I've not fully understood properly, I see that coming a long time in the future.
Thanks, Mike. And by the way, continue with the audience questions. We're trying to work them in as we can. There was a question for Mike, which I think we're going to be addressing later a little bit. But basically, how is this all going to work? Just keeps on coming up, Duraj. And anything you'd add to what Fabrizio and Mike have said? And we'll get our results up here on screen so we can get some perspectives on the poll too. Duraj?
Sure, Scott. So yes, as Mike alluded to, yes, there have been various attempts. CBDC became like a go-to word a few years back. That was kind of an answer that was being prepared for the digitization, or when the digital currencies came in. But the true fact is that what CBDCs was trying to replace was probably large amounts of physical cash in each of the countries, digitize that cash. I think China was the first one to start with the project. They started with the e-yuan. There was some amount of success there. The others started to follow suit. Many countries tried doing it. Ultimately, I think what came to fruition was the fact that there were so many real-time payment schemes available, real-time payments as well as QR-based payments as well as wallet-based payments, that there was no intrinsic incremental value of creating one more CBDC. And hence you see today that CBDC is kind of a term of the past. Now, when you compare them with stablecoins, the value that comes on the stablecoin is that obviously the underlying stablecoins, 95% of them are on US dollar, which is kind of a global settlement currency, and the fact that they are cross-border. The CBDCs were supposed to be very domestic in nature, and they were trying to solve problems that were domestic. Whereas, the reason why stablecoins have really grown, we've seen the numbers, is because they are cross-border in nature, number one. Number two, as I said, there are certain use cases which they can solve for, which the traditional fiat rails cannot solve for, because they are 24/7. They don't have things like cutoff time. The third piece, which is why do people trust stablecoins, is because at this point in time, they are, when you speak about interoperability, they can be off-ramped. That means you can get into stablecoins, on-ramp them. It's an easy process. It's not expensive. And when you want to off-ramp them, yes, there is a charge, but you can easily off-ramp them into US dollar and then convert it into your local currency. That liquidity gives interoperability and liquidity scenarios are leading to the increased use of stable coins as a buzzword in every communication that we have with the FI clients.
Thanks, Duraj. One of the things you and I talked about when we were working together before this webinar was that, how this is actually part of the mix, and something that was brought up by Fabrizio, by Mike as well. Mike, you probably didn't talk about it quite as much. The concern is that if you create these little mini clubs, if you will, that you have to be a part of to exchange stablecoins, you've automatically created a barrier to interoperability. However, I'm still not sure exactly how that's going to work. There's a lot of conversation in the U.S. too about that among community banks, how they're going to fit into all of this. So it's not just a global concern or even a local concern, but I think each local concern is a little bit different here. Fabrizio, your thoughts on the EU? You know, we look at this right here. We're about little over half of the audience is in place. They're actually working on this. The other half are kind of, you know, kicking the tires, if you will. How do you overcome all these questions and the regulatory challenges, the governance needs that people are bringing up, and how will those regional efforts we're talking about help incentivize institutions and their customers to actually add a new stablecoin to the global list? How do you join the club and get that interoperability with all the other ones out there?
So, Scott, we're a payment scheme. So we live and breathe interoperability every day. That's what we hear from everybody. And that's, you know, it's a network challenge. Once is up, but to bring it up there, it's a hell of a challenge. So why? And I agree with Diraj. I don't think the use case for stablecoin is retail payments, especially in Europe. We have SEPA, we have a lot of instruments. I believe today stablecoins, as I said earlier, are used mostly for cross-border, but I think the real big use case is tokenized markets and the way we can tokenize all the assets and distribute assets. So why today is not happening? Because banks don't want to tokenize their assets and then see their deposit flowing out and being in the balance sheet of Tether of Circle. So what's the incentive? Do you see a government tokenizing a bond and then sell it and being paid by USDC? Probably not, or even EURC, probably not. So the only way to push banks to tokenize their assets and really unleash the potential of the blockchain is to have banks protect their reserves. And how do they protect their reserves? By being able to issue their own stablecoin. And now that comes the issue of interoperability. Then if each of them issue their own stablecoin, then you're back at square one because it's not going to scale. So how is it going to scale? By using a centralized standard. And that's what payment schemes have been doing for a long time. So the standard creates a level, a common play level field. So banks can freely issue their own stablecoins, one single brand, but issued by different banks, and they keep their reserves on their balance sheets. And then they can freely use the efficiencies of tokenized assets, lower cost, less risk, and all that. There are some technical issues, but I don't think the problem is technical. There are easy ways to do that. Well, there are ways to do that. I think the problem is in the institutional design, but it's there. I mean, MiCAR is probably more advanced than Genius. They have, common definition of liability, redemption. They have passporting. So I think a lot of the things are there. We just need to develop a smart contract, and I think the first one who will do it and then push the first banks to do it will win. We're in the race. We love to do that. We're also bringing along some of the other payment schemes in Europe to develop a common standard, and I think that's the way forward.
Thank you, Fabrizio. That's excellent, because I know that from Diraj's point of view, and he didn't get a chance to, or I didn't ask him about it, but there's now movements in place in Hong Kong and Singapore to do this. And so that whole interoperability question, Atakan, whether if not from a technical perspective, I understand you're an economist, how could this actually be accomplished from that macro view again, with the U.S. having, let's say, a pretty big head start, and not only the U.S. talking about USDC, Tether and Circle, but what might help smooth that growth or increase the actual staying power of any of these stablecoins from that, that economic or, person on the ground perspective? and even from that political or monetary sovereignty point of view? And then we'll go to our next poll after you finish.
Right. So I guess let's take a look at like a bigger picture of why US is leading in this stablecoin race. I mean, you can point to reasons about how, the legal efficiency in the US, or, they just started early. But I think the bigger picture and the bigger question is that, so the US government is running like massive fiscal deficits at 100% federal debt to GDP ratio. Even with tariff revenue, it's going to go up to all the way to 120% in just a decade. And who's buying all this debt? When you look at the data since 2014, it's not really the foreigners. The foreign ownership of the US that has been declining steadily since 2014. So it's not relying a lot more on domestic households that are quite interest rate sensitive. It's relying on hedge funds doing those basis trades, buying the US debt. I mean, just from 2022 to 2024, 40% of the treasury bills, treasury issuance, was just bought by hedge funds at Cayman Islands. So the US government is in a situation where they need to find buyers for that debt. And stablecoin is one way, right? Because the stablecoin issuers back their coins with T-bills. So there's just the rising deficits and the too much spending, too little revenue just gives more incentive to the government with the worst fiscal situation to accelerate their stablecoin innovation. So we're kind of in a situation where those who are doing bad in terms of fiscal situation has to really step up their games to attract that money. So I mean, the stablecoins, I just see it as a way of financial repression in the US, as a way to attract foreign funding into their debt. So that's my view.
Got it. No, it's very fair. There's even some discussion in the U.S. that they can double dip, because they're not only going to get stable coins to be based on T-bills, with those backing them, but also that there may be a flight of new deposits into banks in the U.S. It's so interesting, because some people are worried about a flight of deposits, and some are talking about deposits coming in even more than they are now. Let's do our second poll here. What would make stable coin program support a must for your company, audience? Is it the fact that you've got great internal expertise and you've already got plans in place for stable coins as part of the mix? Is it increased demand and appetite from your clients, whether that be business or personal customers or consumers or all those? And then, or is it marketplace and competitive pressures that are hitting you from other institutions or companies that you compete against, or really nothing? Are you just going to sit back and wait and see what happens in the marketplace and the various regulatory areas where you work? That's the poll. Diraj, looking at the landscape right now and what you can presently do as a financial institution with stablecoins, what you can support, talk about those use cases you've seen. You mentioned a few at the beginning, but talk about the ones right now that really make sense, and then the future use cases. We don't need a whole laundry list, because I know the audience probably has their own, but give them a few examples that you've seen, because you're on the ground, you're talking to people.
Yeah, sure, Scott. So when we speak to clients, specifically financial institutions, let's start with the fact that they're also driven by their own clients. When their clients are adopting alternate means of receipts and payments, they have to fall in line. Otherwise, they lose the business to another service provider that will be supporting. So as I mentioned, the fiat rails, for payments today are very efficient. They work efficiently, maybe 22 hours a day, 5 days a week, if you see US dollar clearing. And other currencies also have elongated cutoff time, but they are not 24/7. So there are certain markets, for example, if you look at commodities, there could be an element where somebody wants to take a commodity exposure on a Saturday, but you don't have access to fiat rails. But if you have access to stable coins, you could take a position on those commodities if somebody is willing to trade, because those are OTC markets. So you could have a potential where you could buy oil or silver or something using stable coins. The other use cases could be, for example, industries like gaming, where gaming is a huge industry, runs into billions of dollars. But if you have to do a small $5 payment. The fiat rails are expensive or maybe not as instant. But if you look at stable coins, which are on a blockchain infrastructure, which money moves instantly within platforms between digital wallets, that's another area where you could see stable coins as a better mean of exchange or mode of exchange, which is 24/7 and linked to the new age economy. So these are coming up and evolving as those that, these are the kind of requirements of an underlying industry or a customer that are not solved for by an existing framework which is there on fiat. Yes, you can say that maybe credit cards and cards are 24/7, but even there the settlement is T+2, there is a settlement risk, there are charges involved, whereas some of these can be solved if you have digital currency. In future it could be interoperable CBDC on multiple networks. It can also be stable coins, but as long as it is cheap and it moves 24/7, there are use cases. I am not saying that they will completely take away the payments business from the fiat rails, whether it's remittances, whether it is trade payments, but there are evolving industries that can benefit from this infrastructure.
Thank you, Dheeraj. I'd love to hear that perspective, because when I was calling on corporate clients, both very large, international, and smaller, I just keep thinking, what would a customer really want? What makes most sense for them? And I always like to bring sensibility back to every one of these discussions. It's, just because something is new and cool doesn't mean that it actually makes sense for everyone, and it's going to take some time to filter through. That being said, let's get the results of our poll here. We've got, exactly what we just talked about. The largest number on our screen is that increased appetite from our clients. And I do think that that's going to drive this as much as anything, but it's got to be sensible. That competitive pressure from others doing it. We know that there are large consortia right now of banks. There's also large banks that are doing this. There's fintechs doing it. There's a lot of people doing it. But if you look at the first three categories, there are people with the capabilities, but they know that they're going to have to really make things happen when it comes to tokenized assets and all sorts of digital assets. Mike, briefly, if you could tell us anything else you would add regarding, what financial institutions are actually doing, what some of those use cases are missing. Maybe just mention a couple, and how can regulators take those appropriate steps to handle, preserve that monetary sovereignty. And you mentioned it, quantum's coming. So if you could just touch on this before we go to the next question.
Yeah, sure. So for me, I think the big mistake is to be doing nothing. I think every financial institution out there needs to have a plan and an approach. We talk to a lot of financial institutions. We white label a lot of our services for banks, for financial institutions. And it still amazes me that we talk to banks, we talk to FIs, and some of them have no idea. And in this time, this is, you're going to lose. There's no two ways about it. This is here to stay, and you need to have a plan. What I think is one of the big things that's falling under the radar is in this world, we're very good at looking at presentation, looking at marketing, looking at how slick and sophisticated something looks, and not really understanding it. And if you look at a lot of the different stable coins out there, you really need to scrutinize what's in those reserves, because those reserves are not all the same. You have a USDC or EuroC where the reserves are 100% backed by treasuries. You look at Tether's reserves, and that is not the same. They have lending in there, and a lot of the less sophisticated users of stablecoins do not fully understand some of that risk and what they're potentially exposed to. And equally with counterparties, we do not know the amount of leverage in the system in some cases, and the risk that some of these exchanges are taking. This is one of the core components of Amina's business model is regulated. We only believe in regulated crypto. We have an incredibly high bar for any project that we want to associate ourselves with, projects we want to work with. They have to have stringent regulation, and we do a lot of background to really understand who we're working for. Quantum is a really good point, and it's really scary, because I think it's coming at a rate of knots. I'm not sure we're really prepared. I think the possibilities when it comes to advanced encryption and things like that really do pose a risk. And we're seeing more and more, a lot of coins, a lot of projects are being unraveled by very simple bits of code that have been manipulated, that have been changed. And I think this is only amplified, and quantum provides an incredible catalyst to increase this risk and increase this pressure. And whether we like it or not, we're in a world where there's a lot of malevolent players out there that intend to try and profit from companies that don't take it seriously. And I think we've seen this a lot with staking providers as well. There's a lot of external staking providers, and often they learn too late a little bit that they needed to invest much more in cyber, be much more focused around training their people to understand it and to really protect the company. So for me, these are the big areas where you really need to be on your money. You need to understand your counterparties, and you need to have a very good approach to cyber, because otherwise you're putting your long-term success at serious risk.
Thank you. I mean, it's never easy, is it? And especially if you do business in various jurisdictions, the regulatory side is something you have to do. And Fabrizio, same questions to you. Where do you see stablecoins going with this regulatory environment, monetary controls, not to mention that client demand that we talked about? What really has to happen to make all this work? Just, I know you've talked about it, but anything else you would add, or any concerns you would add?
So I would go back to the polls and look at this 44% on demand, and you mentioned demand. I mean, today, if you look who's really using stablecoins, again, if I know Italy is a market, but I think it's a proxy for Europe. There's around less than 1 million people, 5-6%, and don't blame them. I mean, how many people you find that want to take the risk of sending their deposits to, allow me the term, obscure El Salvador company only to invest in Bitcoin, or maybe send some money to Nigeria because they know somebody there? There'll be some people, but I think the majority of us won't fall into those two categories. There are a lot of people who want to invest in safe assets and wants to pay less and wants to maybe be guaranteed by the government. Then the money are safe in a deposit, and there's a lender of last resort. If that deposit has a problem, then you can still access your money. And you can do that by distributing the risk across banks. The banking system works well on that, and avoid single issuer dominance. I think that's the key that we're trying to solve. And I think, again, going back to MiCAR, there is a strong base there. There's still some concerns, I think, in the European Central Bank on stablecoins, but I think we're getting there. I think it's very important to continue to say that euro-denominated stablecoins are not a competitor of the digital euros. They are two completely different instruments. I see digital euros more of a cash replacement. I think Mike said it, or Viraj, while stablecoins are very different instrument that will be used in tokenized assets and a lot of other use cases. So once you get that mainstream through the help of financial institutions, I think there'll be a surge in use, and I think Europe can lead the way there.
Awesome. And one thing I just keep thinking about all this is, it's something Viraj mentioned, all of you mentioned. I mean, we have these same issues with any kind of cross-border payments, with fiat currencies, with conversions. There's a lot of issues that are there. We're adding a new rail. This is part of a new mix that many financial institutions are going to have to take. Atakan, before we kind of get to our last question, and if it's okay if we go just a little bit over, gentlemen, we won't be much past the hour. Your thoughts on all this and the poll results? Does it surprise you to see what the poll says here, first of all? And then what other potential influencers, good or bad, do you see coming in 2026? And anything we've missed you'd like to raise?
Yeah, I mean, to add to what Fabrizio said, so right, it could be sketchy, to send your money to some company in El Salvador. Maybe they could, send it to Nigeria or whatever. But this Genius Act prevents them to doing so, right? They force them to invest in safe and liquid assets like T-bills, deposits, repo market in the US, or just pure cash. So this actually really kind of just builds confidence in the stablecoin because I think one of these algorithmic stablecoins, Terra, 2 years ago or something, they went bankrupt, right? Because they weren't really backing their coins with anything stable.
Oh, I think we might have lost Otacon for a minute. Well, I heard what he was saying, and hopefully we'll get him back in a moment because we've answered a bunch of the audience questions. They've weighed in here. As we proceed to the end here, we just want to get some final thoughts. I mean, we've talked about a lot. We haven't talked about everything. But if you were going to put something at the top of your list to convince any financial institution or a fintech or anyone else who's hesitating, why do you need to embrace stablecoins and other digital assets? Is it, and maybe you're going to need to build it yourself, partner, most likely you're going to partner. What's that one key ingredient? If each one of you could sort of give us an idea of that, where if you were to, because we've had that question asked, what do I do right now? Fabrizio, where do you start?
I can see Mike and I are the only two left here. We're getting attacked by. Jokes aside, I would just say that it's early stage, and given that I believe stablecoins and digital assets are not just new products, but they are infrastructure, and they are shared and common infrastructure. I think right now is when the standards are being designed. So you can either wait and see and then join later when someone else has designed all the standards, or you can have a seat at the table now where the table is being designed, right, where the standards are being designed. And I think right now there is still that opportunity, and I'm glad that a lot of financial institutions in Europe are joining in. So I think that's the key message.
And I think the world would be a much better place if everybody was aligned, interoperable, and trying to come up with those standards. I can't believe that we, frankly, haven't gotten there yet, but maybe we will. Until Otacon comes back, unless he's there right now. Mike, your final thoughts. First thing you prioritize.
Yeah, I think Fabrizio, nail on the head. It's spot on. It's about being in the conversation. It's about having a voice, and it's about giving your opinion, because the change is going to happen whether you're in the conversation or not. So you're, from my point of view, always better to be a part of that conversation. I think what would be good to see is a more global approach, because while I totally agree that the European Union is leading the way when it comes to a lot of the stablecoin stuff, and the US has a sort of more commercial approach, I would love to see sort of more global harmonization, and particularly with some of the BRIC nations. I think we have massive population centers in India, in China, in Brazil, and I would love to. I would love it where we could find something that was actually beneficial for a much wider audience than maybe with a more retail commercial mindset. I think the financial institutions are there to support the financial services sector, and that's paramount. And ultimately, it needs to be fit for the consumer in the same way the payment networks were throughout the early part of this century.
Thank you, Mike. And Duraj, your final thoughts on what to put at the top of the list if you're someone considering stablecoins and hasn't done it yet.
I would strongly urge the use of the word adapt. Look, probably 15 years in text that
You're breaking up a little, but I heard the word adapt.
Yes, I can hear you. Am I audible?
Yeah, I can hear you. Yeah, we can hear you now.
Yeah, okay. So adapt is the key word. I think banks were disrupted by fintechs, and now banks and fintechs are getting disrupted by digital asset companies. It is very important that if we could, sorry, are you able to hear me, Scott?
Yeah, we can hear you.
Oh, I'm sorry. So I think it's very important that we adapt. We kind of accept the reality that this is going to be something which is very real, both for payments as for cross-border payments and store of value for the future. And we need to start building for the future and preparing for the future to be part of this entire digital asset ecosystem.
Thank you. I mean, I've heard set standards. I've heard get on board. I've heard adapt. This is not going away. Find your place. Atakan, your final thoughts.
My laptop.
No, can you hear us okay? I just want to hear your final thought. What would you put at the top of the list if you were advising someone considering, am I in or out with stablecoins and tokenized assets? What would you put at the top of their priority list?
I guess the top of the priority list is that you have to remember that the Genius Act did not get implemented yet. So it's
That's
either
right.
July or the hard deadline is January 2027. So there's still a lot of loopholes in the Genius Act that has to be fixed. It still does not restrict the stablecoin issuer to not pay interest through other means. It still allows stablecoin issuers to put banks in to invest in the bank deposits, but the FDIC regulation only insures up to $250,000. So in the event of a bank run, the stablecoin issuer can also go down with it. I guess it still allows the stablecoin issuer to participate in the repo market, but in the repo market, your collateral treasury has whoever issues the repo has the first priority in that. So, the stablecoin customer could not really get that in the event of a run. So still a lot of problems with the Genius Act, and it doesn't even cover the non-payment stablecoins. So, there's still no regulation for that. And those are the ones that are at most risk of failing, right? Because they could just, invest in whatever. So still a lot of regulation to be made.
Excellent capper to our conversation. I mean, this story is not over. There's no, I can tell you right from being in the US and also having experience on the global stage, I can tell you that there's much more to come. There's active discussions right now about all these things. I think what Europe is doing is great, and what's happening in Asia. I think if we can find some unity and harmony here, we're going to have a better way of or at least another good rail for payments. That's not going to happen overnight. I want to thank our wonderful panel, Atakan Bakaskan, Fabrizio Berlando, Mike Foy, Duraj Bajaj. Feel free to reach out to these gentlemen. You'll find them on LinkedIn and otherwise. I want to thank our audience for weighing in with all the questions and on the poll. We'll do more of these webinars where we talk about the biggest issues without any sort of, these are people from every part of the industry, and we love getting them together for you. We'd like to continue. Let us know if you think there are more interesting conversations that we need to have on a global basis. We got people from Asia, from Europe. We've got an incredible group of, or an incredible audience from all over the world. We'd love to hear from you. Thanks again for joining us. Have a great day. We'll give you back. We're a little bit late, but thanks for holding on with us. Appreciate it. Bye-bye.